Warren Buffett is one of the most successful investors of our time, and his investing rules are quite simple and easy for just about everyone to understand and apply. And he's also famous for his straightforward and sage advice. Now, one of his most popular quotes is, "It's good to learn from your own mistakes, but it's far better to learn from other people's mistakes." And this is especially true when it comes to planning for your retirement. Welcome to Redefining Retirement. I am Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on the toughest challenges that you'll face in retirement today. Now, coming up on today's show, we're going to look at how you can avoid 5 costly retirement planning mistakes that could needlessly wipe out your hard-earned savings. Here's what's coming up. And if you're retired, or if you're nearing retirement, the timing could not be worse, because this means you could be paying a lot more on your IRA and 401k withdrawals. Because the more diversified your sources of income are, the better protected you'll be from things like inflation, market downturns, and recessions. Most people falsely believe that Medicare will pay for all of their medical expenses in retirement. Reality is, Medicare will pay for some of your medical expenses in retirement, but not all of them. I'm really excited about today's topic. Sit back and relax. Redefining Retirement starts right here, right now. Saving and accumulating assets for your retirement is a good start, but it's what you do with your money that really matters. So how will you generate your income? How will you reduce your taxes? How will you reduce your risk? How will you pay for the skyrocketing costs of healthcare? How will you optimize your Social Security benefits? Welcome to Redefining Retirement. I am Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on the toughest challenges you'll face in retirement today. Now today, we are looking at how you can avoid 5 costly retirement planning mistakes that could needlessly wipe out your hard-earned savings. So let's jump right in and let's take a look at the first mistake that you definitely want to avoid, and that is not having an appropriate plan for how you're going to generate income during your retirement. You see, if you hope to retire successfully, then your money, it must generate income for you. And when you do retire, you have an important choice to make. Now, the first choice, that's to live off of your retirement savings. And that means every time you spend your money, every time you write a check or charge something on your card, your retirement savings get smaller. And for most retirees, that doesn't feel good at all. You're living in this state of constant fear of running out of money in your retirement years. That does not create peace of mind, and it certainly doesn't let you enjoy retirement. Now, your other choice is to have your money work for you, where you have multiple sources of stable and predictable income coming in every single month. And because of these multiple income streams, you can do all of the things you've dreamed of in retirement, like travel, hobbies, maybe golf, buying gifts for your grandchildren. The list is endless. Now, obviously, generating stable and predictable income in retirement is a vital component of the retirement planning puzzle. But unfortunately, generating income in retirement, it comes with significant challenges today. Many of the traditional fixed income options like CDs, savings accounts, bonds, they're not as viable as they used to be. Now, why is that? It's because if you do this incorrectly, you are literally guaranteed to lose money when you factor in the impact of taxes and inflation. But then on the flip side, many people are afraid to invest too much of their hard-earned money into the stock market. And a common reason for this is the fear of the volatility that we've been experiencing, and they don't want to risk losing their hard-earned savings. So when it comes to generating income in retirement, here are a few rules to follow. First, your retirement income strategy, it should include multiple streams of income. And those streams of income, they should be stable and predictable. And they should come from different, non-correlated sources. Because the more diversified your sources of income are, the better protected you'll be from things like inflation, market downturns, and recessions. And based on the length of a typical retirement, you will likely experience each one of these during your retirement years. So that's the first mistake to avoid. Now, the second costly retirement planning mistake to avoid, that's not knowing how to maximize your Social Security benefits. Unfortunately, most folks do not realize that for the typical retiree, filing for your Social Security benefits, it can be one of the most important financial decisions that you'll make during the retirement planning process. See, as it turns out, the difference between your best and your worst case scenario, it can be hundreds of thousands of dollars of lifetime benefits. Now, I don't want you to take this decision lightly. Yet all too often, again and again, people continue to make the same mistakes when it comes to filing for their Social Security benefits. And according to Forbes, 96% of Americans lose an average of $111,000 in Social Security income. Think about that, $111,000. That's a lot of money. Now, one of the common mistakes people make in getting the largest benefit that they're entitled to is by only focusing on the amount of their benefit and then nothing else. That is a big mistake because there's a lot more to it than just that. It's important to understand that when you file for your Social Security benefits, it literally has a domino effect on things like your taxes, your IRA, your 401k withdrawals. It can even impact the size of your Medicare premiums. So for those reasons, it is important that you consider all of these things to get the most from your Social Security benefits. And unfortunately, many so-called Social Security experts, they'll tell you that delaying Social Security benefits until age 70, that's a good thing to get the largest benefit check. They'll tell you that's a no-brainer. Folks, that is not necessarily the case. You see, I can show you hundreds of examples where delaying benefits actually cost people money when you factor in the impact of all the things I just mentioned. So things like your taxes, your IRA and 401k withdrawals, your Social Security benefits, your Medicare premiums, and the list goes on. Now today, with so much uncertainty in the economy, so many people, they're concerned about the Social Security program running out of money. They are concerned about getting the full benefits they're entitled to. Now, here are the facts. The Social Security Trust Fund is projected to run out of funds, depending upon which study you read, somewhere between the year 2034 and 2035, with no current plan to fix this problem. So with ongoing issues like sticky inflation, our record national debt, and the threat of rising taxes, it is possible that your benefits could be affected. And obviously, I'd say this definitely plays into how and when you should file for your Social Security benefits. So here's what I mean. I want you to think about what happens when you receive your annual Social Security statement. Now, typically, you get this around your birth date. You opened up. You look at the numbers. You see your earnings record. You see your benefit amount based on when you begin your benefits. And the mistake that so many families make is they think, hey, that's all there is to it. You can take your benefit as early as age 62. You can defer it to as late as age 70. But folks, there is far more to this, a whole lot more. For example, you should look at all of your other sources of income. Maybe you've got a pension. Maybe you have some rental income, some investment income. You should also look at your tax situation. You should also look at your other investments that you have in your investment portfolio. How much of it is in tax-deferred accounts, like your IRA and 401k? How much of it is in taxable accounts and maybe tax-free accounts? And when we do this, we step back and we take a look at the entire picture for a very important reason. And that is because this is where the mistakes are made. You see, most retirees think that the number on their statement is what's available to them. However, that's a really big mistake. Here's an example of what I mean. First, if you're married, you have what's referred to as spousal income. So whether you're divorced, maybe your spouse passed away, or if you're taking a combination of different income streams in retirement, all of these factors can all play a big role in the amount of money you actually receive from Social Security. Now, another example of this would be taxes. Well, why taxes? Because taxes are a major component when it comes to your Social Security benefits. So for example, when you add in your Social Security benefit with your IRA and 401k withdrawals, that can also increase your Medicare premiums. Folks, there are many, many things that can affect how and when you should claim your Social Security benefits. So hopefully you're grasping that claiming your Social Security benefits is not a one-size-fits-all. You want to have a customized strategy that's designed especially for your unique individual situation. This way, you're making an informed decision of how and when to take your benefits to maximize what is rightfully yours. See, filing for your Social Security benefits, it's significantly more complicated than most people realize. Just look at the study by Forbes, where they said 96% of Americans miss out on an average of $111,000 of lifetime income. But we want to help you to avoid this mistake. And that's why we put something together for you today. It's a free, customized Social Security analysis from Cornerstone Wealth Management. Now this analysis, it's going to show you how you can get the most amount of income from Social Security while taking the impact of taxes into consideration, as well as your IRA and your 401k withdrawals, your other sources of income, and your Medicare premiums, taking all of that into consideration. Now here's the best part. It's completely customized to your specific situation, and we're not going to charge you a dime. This analysis, it's not only going to save you a lot of research, it can also prevent you from losing tens of thousands of dollars in benefits that are rightfully yours. So, if you've saved at least $250,000 for retirement and have not yet filed for Social Security, schedule your free analysis now by giving us a call. And when we come back, we're going to take a look at a critical retirement planning mistake that most people overlook. We'll be right back.
At Cornerstone, we believe you should be able to enjoy the retirement you have always wanted. To help you see your retirement strategy from all angles, we created a retirement roadmap, which is designed to help you discover the knowledge you need to take control of your money and live a confident retirement regardless of what challenges arise. So you envision the life you want to live, and we can help you create a plan that leads you down that path. Join us for a conversation about your vision for your ideal retirement by calling the trusted professionals at Cornerstone.
Approaching retirement requires a shift in how you view your investment and income portfolio. Are you making the transition successfully? Author Chris Abts, in his latest book, Maximizing Your Income, will show you how to structure your income while avoiding 10 retirement pitfalls. You'll also learn 3 strategies to create sustainable retirement income. Learn to plan for potential healthcare costs and how to avoid 4 common yet costly Social Security mistakes. The information you gain from this book may help you retire sooner and help you stay retired. Get your complimentary copy today at MaximizingYourIncome.com and take control of your retirement.
Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement. Welcome back to Redefining Retirement. I'm Chris Abts from Cornerstone Wealth Management, and this is where you can count on straightforward and objective advice on how you can make the most out of every dollar you've saved for retirement. Today, we're looking at how you can avoid 5 costly retirement planning mistakes that could needlessly wipe out your hard-earned savings. Now, before the break, we covered the first 2. So let's now look at the 3rd retirement planning mistake, and that is not taking appropriate steps to reduce your tax liability in retirement. You see, most people, they falsely believe they'll pay fewer taxes in retirement. Now, I get why they think that because they're no longer earning a paycheck. But unfortunately, that won't be the case for the vast majority of hardworking Americans. Because when you add up your IRA and your 401k withdrawals, your Social Security benefits, along with your other income sources, you might actually find yourself paying even more taxes in retirement. And on top of this, you likely will not have the deductions you had while you were working. So things like your mortgage deduction or maybe claiming dependents. So taxes may very likely be your biggest expense in retirement. And I suspect that taxes will be even more for the next generation of retirees. Here's why. In the past few years, the government went on a massive spending spree. So we saw trillions of dollars spent on things like economic stimulus, new infrastructure, social policy bills. And today, our national debt is at an all-time high. Now, I want you to grasp something that is really important to understand. Our government does not have money of its own. So in my opinion, the only realistic way the debt can be paid down is by raising taxes. So regardless of all the other challenges in our economy right now, like inflation, rising interest rates, stock market volatility, I believe that higher taxes could be the next shoe to drop. So what could happen to taxes and how could this affect you in your retirement? Well, if you look back at federal income tax rates over the past 100 years, today's tax rates are historically low. Today, the highest federal tax rate is 37%. But you know what the highest federal tax rate was back in the early 80s? During that time, inflation was a major problem, and the top federal tax rate was 70%, so almost double. And while I don't believe that's where we're headed today, our government, they do have a lot of room to move between 37 and 70%. And any tax increase, it could be bad news for retirees. And if you're retired, or if you're nearing retirement, the timing could not be worse because this means you could be paying a lot more on your IRA and 401k withdrawals. Higher taxes on your Social Security benefits, higher taxes on your other investment income like interest, dividends, rental income. And as a result, the money that you're relying on for your retirement could end up being a whole lot less than you thought it was going to be. So the question you should be asking yourself is there anything retirees can do to protect themselves from higher taxes? And the answer is most likely yes. So I want you to understand that you have far more control over how much you pay in tax in retirement than at any other time in your life. But taking back control of the taxes you pay, it doesn't happen automatically. You must act. And it comes down to understanding the difference between tax preparation and tax planning. See, tax preparation, it's probably something you've done every year. Now, with the help of a tax preparer or some tax software, you probably prepared and filed your taxes by every April. But aside from a few deductions that might save you a few dollars at this point, what's done is done. You're just reporting history. Now, tax planning, on the other hand, it's something altogether different. Now, with tax planning, you're looking forward, not backwards, and using tax laws to your advantage. And tax planning, it can be especially powerful during your retirement years. The savings could be significant, and it's not uncommon for us to find tens of thousands, if not hundreds of thousands of dollars in savings. And in talking about tax planning and tax preparation, I want to share a story with you. I met with this really nice couple. They were nearing retirement. They came in. They wanted help to plan properly for their retirement. Now, they had saved about $1 million in their 401k. Now, what they didn't know was this 401k was really an IOU to Uncle Sam. Now, when we ran the Cornerstone Retirement Tax Analysis, when we did that for them, and we started the process of tax planning, we were able to save them over $300,000 in tax to Uncle Sam on their $1 million IRA. Now, is $300,000 a lot of money? Well, of course it is. So this is an area where you really need to make sure that you have a plan in place. And we see this type of savings, we see it all the time. And I want to share this with you because so many people are completely unaware of the impact that taxes will have on their IRA and their 401k. In fact, almost everyone who comes through our doors, they're surprised by how much money they can keep in their pocket by doing some tax planning, instead of just doing the tax preparation. Now, I want to point out that the sooner you begin your tax planning, the more tax strategies that you will have available to you as compared to waiting until the last minute to address it. Now, regardless, think what you would do if you had an additional $300,000 as opposed to giving it to Uncle Sam. Maybe that's travel. Perhaps maybe you don't need to spend it, you just feel better. Maybe you feel more financially secure. So hopefully you're beginning to see how and why taxes play such a big role for retirees. Now, if I asked you how much money you've saved for retirement, you probably know that number off the top of your head. But if I asked you how much you owe in tax on your retirement savings, most people don't have a clue. And I believe that is one of the most important numbers you need to know. Because if you don't know how much in tax you will owe, then you really don't know how much money you have for retirement. So that's why we put something together for you today. Discover how you can reduce your taxes in retirement with a free Cornerstone Retirement Tax Analysis. Here's how this works. First, we'll get some basic information from you. We'll determine the tax saving strategies that are best suited for your situation, and then we'll sit down and we'll share these strategies with you so that you can see exactly how much money you could save. And as we've just learned, your tax savings could be significant. It could be tens of thousands, if not hundreds of thousands of dollars in retirement tax savings. Now, many advisors will charge thousands of dollars for a customized analysis like this. We won't charge a dime. So if you saved at least $250,000 for your retirement, call us to schedule your free customized analysis. And when we come back, I'm going to share 2 more critical retirement planning mistakes that could wipe out your hard-earned savings. We'll be right back. Could your tax bill in retirement be larger than you think? Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. If you're like many savers, you may not know the total amount of taxes you could potentially pay. I believe information is critical to making informed decisions about retirement. If you agree, I want to share a resource that can help. Use your phone camera to scan this QR code. It will take you to a page that generates a quick report that can help evaluate your potential tax bill in retirement.
Behind every photograph is a story. How will your life story be told?
We got the house of our dreams. Thank you for the down payment, Mom and Dad. It helps so much.
20 years ago, I remember hugging you just like this, Dad. Thank you for teaching me strength.
Say hello to Emma. Mom, you gained the title Grandma and a new best friend. She has your eyes, and I know she'll have your heart.
Create a legacy, a story worth telling. To learn how, call 853-9033.
Welcome back to Redefining Retirement, where you can count on straightforward and objective advice on how you can make the most of every dollar you've saved for retirement. I'm your host, Chris Abts from Cornerstone Wealth Management, and today we're learning how you can avoid 5 costly retirement planning mistakes that could literally wipe out your hard-earned savings. Now, the 4th costly retirement planning mistake that could wipe out your hard-earned savings is underestimating the skyrocketing costs of healthcare during retirement. Now, if you or someone you know has had to enter the hospital, even for a non-life-threatening matter, the cost can be massive. While visiting the Amalfi Coast, a client of mine, she fell down the stairs. Before she realized it, the medical costs, after adding them all up, came to over $200,000, and almost none of it was covered by her insurance. Now, if you experience an overnight stay at the hospital, it's amazing that when you factor in copays, deductibles, and out-of-pocket expenses, the cost can add up to be tens of thousands of dollars. And according to MarketWatch, a healthy average couple aged 65 today will spend an astounding $662,000 on retirement healthcare expenses. Now, that's a lot of money. And as we know, it's not getting any less expensive. And because of inflation, imagine what healthcare will cost 5, 10, or 20 years from now. And unfortunately, most people falsely believe that Medicare will pay for all of their medical expenses in retirement. Reality is, Medicare will pay for some of your medical expenses in retirement, but not all of them. So you may still find yourself coming out of pocket for a significant amount. Now, in addition to this, I believe it's wise to also factor in a potential long-term illness and the associated costs. So while it may be hard to think about long-term care when you're healthy, the statistics, they're not in your favor. The latest research says that the average 65-year-old has a 70% chance of needing some type of long-term care during their retirement years. And the cost for long-term care doesn't come cheap. The average cost of a private room in a nursing home today is $120,000 a year. A semi-private room, $110,000. And a home health aide, $61,000. All right. Let's now shift our attention and let's look at how you can avoid the 5th costly retirement planning mistake that could wipe out your hard-earned savings, and that is taking too much investment risk. Now, unfortunately, we see far too many people make this mistake all the time. Because all too often, investment risk is something that many retirees don't even think about, which makes it one of the most common mistakes in retirement planning. And it's actually one of the most important and critical things that you must address to protect your hard-earned savings from stock market volatility. And given the risks that we're currently experiencing in the economy today, like inflation, rising interest rates, tightening monetary supply, market volatility, it seems like everywhere you turn, there's risk. Currently, the stock market risk has increased. Bonds have also been struggling. And many of the traditional fixed income safe havens like CDs and savings accounts, they're guaranteed to lose money when you factor in taxes and inflation. And this makes having a diversified investment portfolio that aligns with your appetite for risk makes it potentially the single most important thing you can do to protect your nest egg during a sudden downturn in the stock market. Or what if we experience an extended market downturn? Bottom line, the closer you are to retirement, the less risk you should be taking because you no longer have a long enough time frame to recover from a major market pullback. Folks, we get the opportunity to meet with so many people. And when we have that initial visit, we find that the vast majority of people are taking far more investment risks than they realize. And when we listen to their idea of investment risks, they tell us one thing. But when we look at their investment portfolio, it says something entirely different. And when you have wild swings in the market, like we've had the last few years, you can unknowingly be invested too conservatively or too aggressively. And neither one of these scenarios is good. One of my favorite quotes from Warren Buffett is this. He says, "It's insane to risk what you have and need in order to obtain what you don't need." And this is one of the vital concepts to remember when you're making critical decisions about your investments. Folks, updating and rebalancing your portfolio is just not a one-time occurrence. It is something that you should do on a regular basis, as well as when there's, say, a significant stock market volatility and when you experience a life-changing event. And for a retiree, a properly diversified portfolio, it's going to be a whole lot more than just a simple mix of stocks, bonds, and mutual funds. And your investment portfolio should be totally unique to you and your specific situation. Bottom line is this. If you retire in a strong economy and strong stock market, you're on easy street. The wind is at your back. But if you retire during a downturn in the economy or during stock market volatility, that is a very different story. And that's where saving and investing alone, that's no longer enough. You need a comprehensive plan, or else you're just setting yourself up to fail. And that's why we put something together for you today. We will create a customized plan for you. We call it the Cornerstone Retirement Money Map. This is a plan that will stand up to the toughest challenges you'll face in retirement. Allow me to explain how this works. First, we'll get some basic information from you. We'll put together a comprehensive plan specifically designed for you, which includes reducing your taxes, generating your income, reducing your investment risk, paying for healthcare, getting the most out of Social Security, and so much more. Ultimately, this is the one tool that could help your money go a lot further in retirement. Many advisors will charge thousands of dollars for a customized retirement plan like this. But here's the best part. We'll create this customized plan specifically for you, and we won't charge you a dime. So, if you saved at least $250,000 for your retirement, call us today to schedule your initial analysis. That's our show, and I hope you enjoyed it. Thanks for watching, and I look forward to seeing you next week.
Jolly good show.